very, very important thing I want you guys to consider when you are doing a subject to transaction is what happens if the due on sale is called. It is a big risk. And if you guys don't fully understand it, you guys could potentially get yourself in hot water, all right? But if you understand how to correctly do it and you have mitigations for the due on sale, then you could take advantage of an incredible way to buy more properties, whether you're buying these for rentals, whether you're doing fix and flip, like I do with the Revive method, whatever your strategy is, having the SubTo option in your tool belt, we all know how powerful that is, right? We've built a whole community that we're all part of around this, but you gotta understand the due on sale clause, okay? And you gotta understand how you mitigated it. How many times do you think I've seen the due on sale called with myself already? In my probably, oh man, of all our transactions and all our deals we've probably done 200 plus. I don't know the number off the top of my head, but how many times do you guys think I've seen it? I think I've had it 3 times happen to me doing due on sales. And how many deals have I bought subject to? I've probably purchased, I don't know, maybe I'm going off the top of my head. I should have these numbers, but I would say done about 20 SubTo, bought property subject to, and I've had 2 or 3 of them called. I think it's becoming more common now, but as I'll get into this, there's definitely one big common theme of when I'm seeing it's happening, but I want to talk through how I'm mitigating that. And then at the end, I got something really cool for you guys. If you're interested, I want to talk through, I'm buying this 120 unit multifamily right now. It's a hybrid where we're taking over the seller. Well, the plan was to take over the seller's loan, give the seller some cash up front, and have the seller carry a big portion of the purchase. All right. But I want to talk to you guys. I had some incredible conversations with the banks and with like high level investors on how we were thinking about the due on sale, because it was $6 million that we were taking over loan subject to, right? So if that baby got called, $6 million, we wanted to have a contingency plan. So it's really cool kind of talking through it. Okay. So you guys ready to jump in? A little bit of due on sale today. All right, let's get started. Okay. Let me ask this. How many of you guys understand what the due on sale is? So due on sale, that is what protects the bank, right, from you just transferring the loan. So if you do think about it, if you go sell, so just fundamentally think about when we buy a property subject to, Pace does such a good job explaining this, but there are 2 things that are transferred on it when you close a property, typically 2 different documents. There is the deed, which is showing who has ownership of the property, right? There's the deed, and then there's the mortgage. But most people, a lot of agents even think, and you guys might have until today, think they're the same thing. They're separate documents. There's a deed, and then there's a mortgage, right? So when you buy a property subject to, you change the deed, so you become the owner, right? But the mortgage does not change. It stays in the current seller's name, okay? Now think about the bank's perspective and maybe put yourself in their shoes. Maybe some of you guys are private money lenders out there. How would you feel if you were lending money to someone in the community to do a fix and flip, and you lended them money in first position, and then they went and sold that property to somebody else and didn't pay you back, right? You guys would probably be not very happy, right? And you probably would write something in your contract that says, hey, you cannot assign this property. You cannot sell this property without paying off the loan. So what the banks have to protect themselves from you doing that is called the due on sale clause. All right. That means that essentially, if you were to transfer or sell part of the property without their approval and without paying off the loan, they can do what's called the due on sale clause. And what actually happens is they would be able to go in and say, hey, they'll go back to the paperwork, and because it's part of every one of your guys' loan agreements has some sort of section in there that says this, right? But essentially they could accelerate the full balance due. So what they would happen typically is they see this and they say, hey, you transfer the deed, you didn't pay off the loan, therefore we need you to pay everything, the full balance off within, typically the window is like 90 days, right? But I've seen it happen even shorter. I've had some people be like, this needs to be paid off right now, or the foreclosure process starts. But that's a very key thing for you guys to understand is what actually happens if they call the due on sale clause, okay? The lender's recourse is what's called, they're gonna have to go foreclose, right? They have a mortgage on the property, so now they can go and foreclose on that property and take it back and regain ownership. That is their mechanism to protect themselves, right? But this process typically takes around, again, state to state dependent. It could take usually I've seen a minimum of 90 days to get through a full foreclosure process. So if you guys can kind of play this out, and I'll play it out in a couple situations I've seen, is if it happens, maybe actually you guys want to start with an example when I've seen it and exactly how it went down. We'll start there, okay? So my first due on sale happened to me. We had bought this property. This was actually a condo. I own a 66 unit apartment complex in Casper, Wyoming. And each one of those little units they're condos, right? So they're individually owned. So my goal was to buy back, I'm still trying to do this. I want to buy all the units so I can just group this thing up and have it be a nice, straightforward multifamily, because I don't love being a HOA manager or president. It's not my favorite thing to do. I'd rather just group them all together. Okay. So we were buying a couple of the other units. Well, this unit we had bought, the seller, here's a kind of a key component, is the seller had used a loan that was an owner occupied loan. And this has been a common thing with my due on sales, is there are just some lenders that their loan products are only designed for owner occupied. Does anybody else in their states have loan products like that, or that are just designed for owner occupied? And sometimes they'll do like down payment assistance. So in Wyoming, there's WCDA. It's basically a housing authority that helps fund people's down payments, right? To where they don't have to come out of pocket at all, right? But typically these companies or these mortgage or these banks, they are very strict on the due on sale. They are not okay with you transferring the deed. And I'll kind of show you guys that example here in a second. Okay, so anyway, when I took over this condo, they already had an owner occupied loan. So I'm like, hey, I knew I was going to refinance all my property. So this big multifamily, my strategy was to fix up all the units and then refinance it and be able to pull back some of my money. So my thought process was, if I can buy some of these other units and I don't have to go tie up all my cash and just take over their existing loan, I'm planning to refinance anyway. So it shouldn't be a huge deal, because I actually knew who the lender was, and I knew it was a smaller bank that's in Wyoming, it's WCDA. Okay, so I knew I had it. So that was immediately, when buying due on sale, you want to think about what are your options if the due on sale gets called, right? So I already had a plan in my head of like, okay, if the due on sale gets called, worst case, I'll refinance and pay it off and we'll be okay. All right. So sure enough, we took over the property, we bought it, we closed, we went to the title company, they transferred the deed, but we left the mortgage in place. Well, here's what happened. You guys curious actually how they found out? It's a ridiculous one. You're going to shake your heads when you hear it. I still do. I still shake my head. My team, my admin, they did not set up the auto pay correctly. So after a couple months, the auto pay wasn't going through, the payment was late, and they notified the original seller. And I think they actually went and checked the deed and saw that the deed was transferred. So when they saw the deed was transferred, they immediately got very upset. They sent a pretty nasty email to the seller, and they actually reached out to the title company. They're like, why did you close this property? They didn't pay off the loan. And the title company's like, we just did our job. The contract said that they were buying it and leaving the existing loan in subject to. So anyway, bank did not like this. And actually the title company called me and they're like, Casey, you need to fix this. Like now I'm getting, literally the owner of the title company called me. He's like, I'm getting a bunch of heat from this bank and they're saying that they're not going to do any of our business. So I immediately had to go into, well, I guess first step I did is I called the bank. And actually I did this on a Problems to Profits call a while back where I actually called the bank, but I literally just called up the bank and said, hey, here's what we're doing. I own this big apartment complex. I own 66 other units. I bought this one. I'm planning to refinance all this here in the next 12 to 24 months once I improve the value. Okay. So I just want to make these payments until I'm ready to refinance. Do you guys, is that really that big of a deal? Like if you're making your payments, are you okay? Because in general, most banks like Wells Fargo, Rocket Mortgage, these bigger banks or these big service companies, these big national kind of mortgage companies, they don't, as long as they're getting their payment every month, they're pretty happy. Okay. Now, again, there could be different instances where they're not okay, but in general, if they're getting paid, they're happy. So I approached this small bank and I'm like, hey, but if I keep making the payments, why does this matter? You should be good, right? Anyway, they're like, no, we're not good. We're not happy. We want this paid off as soon as possible. So I tried to say, hey, why don't you just wait 12 months till I refinance everything and I'll make the payments? They're like, no, we're not doing that. So I actually had to do my kind of last resort on this one, which was I went to a small bank, another relationship I had. I'm like, hey, I need to refinance this unit. Will you go finance it? And I was able to actually still finance the whole amount because there was some equity. And this, guys, here's another important point I want to make with you guys with the due on sale. You want to be very careful when you're buying a property with no equity. Because if you buy a property with no equity and they call the due on sale and you don't have the money, because most banks are going to want you to put, especially for an investment type loan, they're going to want you to put like 25% down. So if you don't have the 25% in cash and you got no equity, you might not even have an option to refinance. So that's something I want everybody to be really careful for, okay? There are still instances where you can probably structure this and still do that, but you need to be very, very careful if there's no equity. So thankfully on this deal, I'd already bought the deal with equity. So I just went to my bank and said, hey, give me a loan. Can you just basically pay this loan off and underwrite me and basically give me a portfolio loan? And they said, yes, we refinanced and we were fine. So let me kind of recap a couple like big sort of high level what you could do if the due on sale happens, right? First one, always call the bank first. As I mentioned on that scenario, I called them. Another scenario I'm going to give you, I'll wait to give it to you in a second after I list this, but I'm going to give you guys another example when I called them on problems to profits and what they said, right? But talk to the banks, okay? I always like to say this one next, right? Is you could deed the property back and essentially unwind what you just did, and you could set up a lease to own agreement, right? So on a lease to own agreement, you don't transfer the deed. You're still making payments to the seller, and you're just a little bit less protected on a lease to own agreement. You could also do a contract for deed or land trust. There's lots of different names in different states, all right? That's another way to essentially accomplish the same thing without transferring the deed and to protect yourself, okay? But the other one is kind of worst case scenario, as I've done and I mentioned, you could just go get a refinance. As long as you're buying a property that has some equity or you've got some cash, you can refinance, pay it back. Then the bank's always going to be happy if you do that, right? Because then they're out of the picture, okay? So guys, a second scenario, which again, I called this bank. This is, how long ago? It's probably 6 months ago on Problems to Profits, because I'm like, hey guys, you want to see me actually work on this and show you what it looks like to call the bank and be like, hey, what do you want to do here? Like, I'm making the payments. Why are we trying to foreclose on this property that's like payments are being made? Like, because guys, at the end of the day, think about it from a bank's perspective. If they know it's going to get paid, they don't want to foreclose. That's a process. It's a pain in the butt. And at the end of the day, the bank doesn't want to own that property. They want to work with you. All right. The bank is wanting to lend out money, not be a property owner. So what I did is on this other scenario, I called the bank. This is crazy, guys. This was and maybe this is why it lended itself to not working out the way I hoped. But I called the bank because this property was a mobile home, but it did not come with land, right? And this bank has this unique loan product where they'll actually lend on mobile homes that aren't attached to the land. Because in case you guys don't know this, banks do not like lending on mobile homes without land, right? But if it's a mobile home on land, it's a little easier. So I call these guys. I'm like, hey, I'm an investor. Like, it's a local market. They know who I am. I'm like, I just want to keep making these payments. And like, because the balance was like $38,000. And their payment was super low, good interest rate. I'm like, just let me keep making the payments. What's the issue here? But they're like, no, we can't do that. We do not allow, it's our policy. We do not allow investors to be in these type of loans, right? Like, they sold the property to you. Now we need to foreclose. And I'm like, come on. So I tried to work with this bank for several months. I was like, can I just assume it then? Can I just formally assume it? They like, well, we'll check. And they came back and they said, no, they're like, you don't live there. Therefore you can't assume it. It's a bank policy. And at the end of the day, I'm like, guys, are you going to go through all this headache to foreclose on a $38,000 trailer when you have a great borrower who's making the payments? Anyway, but it was one of those banks where it's like, they were going to stand behind their principle and not make any exceptions, even though it made zero business sense. They were going to go through for the closure. So unfortunately on that one, I had to bite the bullet, and I just went but the problem was I can't go refinance a trailer without land, right? I'm actually still trying to find that lender. So if you guys know any PMLs that could lend out at like 8% and will lend in, it could be a first position lien, but the problem is there's no land. So I ended up, actually, this was earlier this month, I just had to go pay it off. I paid off like $38,000. So now I have it free and clear. So it cash flows really well, but I don't like trapping in all my equity in a property like that. So anyway, that was to me the worst case scenario, is I just had to pay it off, had to keep moving forward. So that was kind of the second example. So here's another cool way. We'll go into the multifamily stuff now. This big one I'm buying. And this is going to be another strategy I want to share with you guys on how to structure a deal where you can mitigate more of your due on sale risk, right? So this works way bigger when you're buying a property in an LLC. So this scenario, we're buying 120 units, and I'll give you guys the kind of capital stack. All right. So our purchase price, using rounder numbers, is like 15.5 million. We are putting 3 million down. All right. The seller is going to carry 6 million at 4% interest only. Right. And so what's left over is about $6 million of their current loan that's in place, and it's around 6%. So when we were structuring all this deal, we're like, hey, we'd rather take over their loan. It had a little bit more favorable terms than the market, right? Not by a ton, but if I go to the market right now or go to a bank or a small bank, I'm probably around 7%. We actually ended up finding better terms, which is pretty surprisingly with my partner. But in general, that like those loan terms weren't terrible. So we're like, let's just leave them in place. And the big thing was to make the transaction easy and not have to go pay for another appraisal. Like, and on a big multifamily, that's like a very expensive appraisal when you're getting an evaluation on 120 units, right? Those are like thousands and thousands of dollars. Okay. So I'm looking at this deal, but here's the cool thing is the seller owns this asset in an LLC. And fortunately, this asset, it's the only asset in that LLC. So think about this. This is a really cool strategy to do is we originally proposed, why don't we buy the interest of the LLC? That way they're going to sell us, essentially they're selling us their LLC. Okay. So now think about the title work in the bank. The bank in theory should not have an issue because nothing changed. Right? The property got sold, but the same LLC is still listed, right? Nothing actually, does that make sense? Like nothing actually changed because they bought the asset in the LLC. Now all they did is sell out some of their ownership of the LLC. But what you'll find is when you read the fine print of these big, long legal documents, when you go sign for a loan, we all know what those are, right? You're going through this thick stack of paper, all right? Buried in all those terms says, they're all different, right? This bank, I think, said if you sell more than 20% interest in the LLC, that they would have to approve it. Or if not, you would be in default. And in which case they could call the entire balance due. Again, that's why it's called due on sale, is they could call all the balance of the loan due upon sale. Because we were looking at this, and we're like, why don't we just buy the LLC? We'll give the seller a down payment and structure it all that way, okay? So we were literally going through this. I actually reached out to Pace on it to figure out what he thought. Because here was the hang up is my partners, right? So I'm actually working with a family office that is partnering with me on this. They're putting up the $3 million. They have really big banking relationships. And at the end of the day, this is a first for me because my thought process was, let's just close this thing. The rate's 6%. And if we got to go, if they call it due, we'll go refinance and we'll have plenty of time. There's equity. Like we can just go refinance and it's not going to be a huge difference in the rate, right? Because sometimes I do want you guys to be cautious, right? Because if you're buying a deal that only cash flows because you're taking over a 3% loan and it won't cash flow at 8% and there's no equity, you could potentially get in a hot water there, right? Because now due on sale gets called, you got to go borrow at current market interest rates and now the deal doesn't work, right? That could be scary. But in this situation, I'm like, the market interest rates and the rate we had was not a huge delta. So I'm like, let's just get this done. And if they call it due, they call it due and we go refinance. But my partners, they do a lot of big deals and they know all these big banks and they're like, we just don't feel comfortable because technically we would be breaching the contract was their biggest thing. And again, I think that's something that shouldn't be taken lightly, even if we all know that we're probably just trying to accomplish something that's a win-win for everybody. At the end of the day, they were breaching the contract. So my partners they're like, you know what? We don't want to take that risk. Let's just take this down. So we actually went and got our own financing and we're closing this in the next couple of weeks. And the crazy thing is these guys, this family office, you guys will get a kick out of this. Oh, this is really cool because there's a whole nother layer to this I want to explain. But they have a line of credit through JP Morgan or some other big institutional bank because they're a family office doing obviously really well, have a lot of assets, and they're actually able to borrow it like 5.5% from their line of credit. And they don't have to get an appraisal. So that is actually way better than taking over that existing loan. So it's even better terms, so which is pretty cool. And actually, guys, I'll share this right now. I'll put this bug in your guys' heads or put it on your radar. With this family office, I actually just had this conversation yesterday. And I said, hey, if you guys can borrow at 5.5%, why don't we work together so I can lend out money in the SubTo community to people at normal like private money terms and be able to lend out at maybe 10 or 12 or maybe even 15% on a second lien position deal, right? Because what I found, I don't know if you guys have seen this, I'm going on a complete rabbit hole, but I think some of you guys, this is going to be like, yes, Casey, I know what you're talking about. What I found in the SubTo community is it's harder to find lenders to do gap funding or people who want to be in second position. Has anybody seen that when you're trying to go get a loan done and there's already a first position, really good, like 3%, but you need to figure out the gap funding in second? Well, I've just found there's a lot of there's a lot less people who will lend on that. And the reason is, like, if some of you guys know like Chai and Prakash and some of those guys who lend out a lot of money in SubTo, what they do is they work with other banks that help finance that. But you can't go to a bank and say, hey, I want to fund in second position. A bank won't touch that. But what this is cool thing is what I'm working on is because it's a line of credit, we could lend in second position and help kind of, I think, help solve that gap that I see in SubTo, where like there's people who have good deals. And if you know how to underwrite it, again, meaning when I say underwrite, as long as the first position loan plus the second is my numbers like under 70%, I think it could be a safe loan, right? So anyway, I'm working with this family office to figure out if we could start helping students lend out on deals like that. Would anybody be interested in stuff like that? If anybody's interested, email me, Casey at YO Houses, if you guys, because I've honestly, guys, I've had to build really deep relationships to find people who will lend on deals like that. Like, people are typically lending, like if people lend me money on that mobile home that doesn't have land, they're more lending based on to me, right? They understand that I'm going to take care of them. And right. So when people lend in second position, it's typically based on relationship because they think it's not as well protected. Anyway, I think it's a really cool opportunity. So I wanted to highlight that story because I was looking at the due on sale much differently when you're looking at it on a big scale. And there's a lot that goes into it. Because here's the other cool part is like, we literally got on a conference call with the bank because we finally decided to be like, you know what, we're going to go let the bank know what our intent is beforehand, right? We're going to have the conversation. It was a credit union, that $6 million loan that we wanted to take over. So I reached out to him and said, hey, we want to buy the LLC. Do you guys have any issues if we take over this loan? I'm like, and we even sent them our financials, like my partner's balance sheet to show them, hey, this is, you're actually, because our whole pitch was, you're actually in a better position now that we're in here because of our balance sheet versus the past owner's balance sheet. But despite all that, it was still going to be a lot of headaches, a lot of paperwork, just because I'm just telling you guys, when you're working with these banks, they have so many policies, especially the small ones, and they don't like to go out of their policy. So anyway, we ended up having to just get our own loan on that one. But I wanted to kind of talk you guys through the strategy and ultimately get you guys thinking about, if you're going to go buy a property subject to, I want you guys to be thinking preemptively, well, what happens if the due on sale gets called, right? Am I going to refinance? Because do I have enough equity to refinance? Okay. Could I deed this property back to the seller and then set up a lease to own? That's another great mitigation. One last one I'll give you guys that I'm doing, because people ask me all the time. Let's say I'm buying a really thin deal that doesn't have equity, but it cash flows. What I'll do, especially if I'm gonna wrap it, because sometimes there's a ton of people that do that in this community. They'll buy it, take over the 2% or 3% loan, and they'll wrap it around to somebody else. But if there's no equity, there could still be some risk, because the last thing you want to happen is that gets you go wrap it to somebody else, you're out of it, and that guy defaults or something happens, and now you create this big mess. So if there's no equity, what I like to do is I like to be very upfront and disclose that to my seller and say, hey, there's no equity on this deal, because a lot of times I'm the only one that can help them anyway. And so I say, hey, there is a risk that this due on sale gets called. And if it does, this is what we're going to do. But I make them sign something and said, I'm not liable for that. You understand that the due on sale could get called, but this might still be your best option, because it's just really helpful. Because a lot of times those people, they're bleeding every month because they're having to make that payment. And maybe they've already moved and they got 2 home payments, and you got somebody who can move in and be a wrap buyer. So anyway, point I'm making, guys, is there is some ways to structure this to where you don't have to take all the liability. But if you guys take away anything today, I want you to take this away. When you're doing a SubTo, understand your exit strategies, understand your contingencies if the due on sale gets called, and make sure you plan for that on the front end. Because guys, here's one thing is A, you're just going to protect yourself. But B, when you can articulate that and show that to your seller that, hey, if this happens, we're going to do this, you're going to separate yourselves from everyone else. They're going to be like, oh, wow, this guy actually cares about me and my interest in if these things happen. And it's going to build a lot of trust and a lot of credibility for you. So hopefully I've brought in some awareness to due on sale for you guys, that it does happen. And if you have a plan for it, it can be so, so powerful. Because if you guys, again, I think we're all in this community for many different reasons, but it's called SubTo, right? SubTo is one of the coolest strategies we could do, but we need to understand the risk and how we mitigate them.